There are a number of different ways that a business entity can be organized. There's a sole proprietorship, there's a partnership. The one we're going to focus on in this class is the corporation. It's because it's the most complex and it's the focus of this course. One of the reasons why we focus on corporations is because the vast majority of business activity takes place and is conducted by corporations. The vast majority of large companies are organized as corporations. And if we understand the financial issues that face corporations, that can easily be applied to the financial issues that face other types of businesses. So what are some of the key characteristics of a corporation? First, a corporation is a distinct legal entity that exists permanently. So suppose you want to form a business and you want to make it into a corporation. You would draft papers, hire a lawyer, and you would go to the government agencies and the courts and get this corporation created. So you'd go and get that charter, and that corporation would continue to exist even if you sold to somebody else and they sold to somebody else. It would continue to exist. Corporations are like people. They have to pay taxes. They can be sued. They have obligations to follow a variety of rules. Second, and this is a big one, especially in large corporations, there's a separation of ownership and management. So take a typical large company like Pepsi. There are tens and tens and tens of thousands of people that own part of that company. There's no way that they could effectively manage it. First of all, it's not clear, or it's not the case that a lot of those folks actually want to run a cola and a soda and drink and snack company. A lot of folks got into that investment because they saw it as a good opportunity, no interest in running it. So as a result, the owners elect a board of directors who acts on their behalf. They hire the senior managers, and they're the folks that manage. So there's this separation, which we'll revisit in a little, that's really important with corporations. It's relatively easy to raise funds. They can issue debt by borrowing, or they can issue stock by bringing in new owners, but the corporate structure lends itself well to raising funds. And finally, there's limited liability for owners. So suppose you've got 10 people and they all kick in $1,000, you got $10,000, start a company, and suppose the company gets sued and now they owe $50,000. Well, the corporation can only become worthless. The entity that is demanding $50,000 can't come knocking on your door and the other owner's door saying, give us more money. Limited liability means all you can lose is what you put in. So financial managers ask two questions traditionally. The first is, where should we get our money? That's called the financing decision. So a firm needs money to run a business. Do they issue debt? Do they bring in more owners? If they issue debt, do they borrow for a year? Do they borrow for 5 years? Do they borrow for 10 years? Do they borrow with something that's a fixed rate or a floating rate? If they issue shares, what kinds of dividends do they pay? Those are the kinds of questions that financial managers ask. We'll look a little bit at some of the instruments that get used to obtain funds, but we're not going to spend a lot of time, if any, this semester in Finance 301 identifying the best ways for firms to raise money. The second question is one that we will spend a great deal of time in this course. How should the firm spend its money? It's called the capital investment decision or the capital budgeting decision, and it basically involves how should a firm spend money, and it often involves big decisions like whether to buy new plant or equipment, whether to expand into new products or new markets. Do we expand over into China? Do we move into Canada? If we're a shoe company, do we expand into other lines of clothing? Those kinds of questions. Does this make sense for us and for our company to spend money this way? Financial management and finance is really important for all managers. Senior executives, so if you have ambition and you want to rise to a point where you're senior manager, you got to understand all aspects of the company, and that includes finance. Marketing managers. Marketing managers have to be able to understand whether particular campaigns they're pursuing add value. So suppose you're incredibly creative, do great market research, and you've identified an ad campaign that can bring in lots of new customers. The question is, based on how much it costs and the resources needed to make that campaign happen, how does it affect firm value? Financial analysis helps with that determination. Finally, senior HR managers, they're increasingly coming from other parts of the firm. So what that tells us is that they must understand all parts of the firm. There's an increased premium paid on people understanding the firm. So therefore, if you understand finance, even if you go straight into HR and want to become an HR professional, by understanding the basics of finance is going to help you understand what kinds of people are going to be, or what it's going to take to attract and retain and develop the folks that do finance for your company. Even if you're not doing it, it gives you better insight into those folks at your company, which can help you do a better job and help your company be more successful. Finally, if you're an operations manager, you're really good at identifying systems. Again, the question is, for the cost, for the resources needed for this system, does it make financial sense? So this class, finance in general, are important for everybody who's interested in taking on a business or management role. So one of the things that's interesting is that corporations have different stakeholders. These are people that have a stake in how corporations perform. But a lot of times they have conflicts of interest. Different parties want different things. So, for example, shareholders generally want the firm to maximize value. They put their money up, they took the risk, and they want the greatest return that they can get. Now again, they want the company, and the company should act within the law, but given a set of choices, the shareholders want the managers or want the company to pursue those choices and those alternatives that will lead to the greatest value. Other stakeholders have different priorities. So for example, managers or employees may want to get paid as much as possible. The local community wants a lot of jobs to be created, wants a big tax base. Suppliers want to be repaid. The government wants to get its tax revenue. So there's all these different parties that have all these different interests, and sometimes there can be a conflict. So employee stability doesn't necessarily correspond with shareholders maximizing value, because it could lead to overpaying or hiring more employees than are necessary and not laying off employees when they're not needed. The big conflict of interest, the one that can have the biggest effect, is the one between managers and shareholders. And that comes from the fact that there's a separation between owners and managers. And so shareholders, as we've talked about, they want value to be maximized. And managers aren't necessarily always going to make those choices. Oftentimes they're going to look out for their own best interest, maybe do some things that increase the prestige of the firm. Some people have speculated that's why there's so many mergers and acquisitions, and so many of them don't turn out to be as successful as they had been billed ahead of time. Managers may also do things like run up costs by excessive use of the corporate jet or extra lavish offices, and so it doesn't have to be out and out fraud. It's a real gray line, but often managers we wouldn't necessarily expect to always make decisions that are in the shareholders' best interest. So given that, there's a creation of agency costs. There's two elements to agency costs, or two sources. The first are the costs that take place when managers pursue their own interests at the expense of shareholder value. So again, if they pay too much for an acquisition because they really want to be a manager and executive at a really big company, so the company may really be worth $800 million, but they'll pay $900 million. Excessive use of the corporate jet. They may have two projects. One's real glamorous, it's in Las Vegas. The other one may be a lot less glamorous, it's in Iowa. The managers may be more inclined to go for the one in Las Vegas, even if it's not as value enhancing to the company because of their own benefits and their own prestige associated with it. The second kind of agency cost is the fact that shareholders know that managers can behave like this, and so shareholders incur costs to make sure that managers pursue shareholder value. So you may have a compensation package that aligns managerial incentives to investor goals. So it costs money to develop this, it costs money to monitor it, and it may actually result in paying the managers more than you would have had to had they not had this incentive issue. So how can we try to control agency costs? A really good way to reduce it is with effective corporate governance. So here's a formal definition. It's a complex system of contracts, incentives, and understandings that determine how a corporation is directed and controlled. So basically, system of contracts, making sure the managers are prohibited from doing the kinds of things that shareholders would want them, that their incentives are such that they would get rewarded and compensated more when they do the kinds of things that shareholders would want to. Understandings, it may be the case that big decisions aren't made until various parties are it's discussed with, so everyone's on the same page. Some other examples would be separation of powers. So you wouldn't want the same person who's keeping track of where money goes to be the person who can write the checks. You want those to be different people so that somebody writes a check, someone else is keeping an eye on it. There's independent members of the board of directors, folks from outside the company, and there's audit procedures where you come in and you check to make sure everything's adding up. So these are just some examples of keeping everybody on the same page. So in this course, we are going to wear our finance hat, which means that when we're conducting analysis, when we're making decisions, when we're doing our evaluation, our primary focus, which is the one that ethical managers should have, is the value maximization of the firm. So if we're evaluating a choice, does this increase, does this maximize the value of the firm? If it does, we will pursue it. Again, we don't want to violate the law, but within the context, but within the law, we have a lot of flexibility as managers to accept and reject and projects and move in different directions. It is ethical, and that's what our focus is going to be on, is on maximizing value.